Welcome to Getting Started with Secrets of a Pivot Boss. I'm Frank Ochoa, aka Pivot Boss, and I'm the author of the book Secrets of a Pivot Boss and founder of Pivot Boss and Pivot Boss Masters. Thank you for joining me for this SPB Bootcamp. I'm extremely excited about this training as it will provide the essential foundation that all successful traders must learn before moving on to more advanced topics. As a matter of fact, my book Secrets of a Pivot Boss lays a professional foundation for aspiring traders and active investors, teaching concepts that professionals learn as they begin their journeys into the markets. This training is designed to jumpstart your engagement with the book so that you can absorb the more advanced topics that are also covered in the text. It is my sincere hope that these concepts will help you understand the markets from a professional standpoint so that you may engage the markets with confidence and success in the years to come. Without further ado, let's get started. Secrets of a Pivot Boss provides you the edge you've been looking for. And I'll start right off the top with this fantastic quote that I received from AC. He writes, "I came upon your book by chance and was amazed by what I was reading. Your book is brilliant." And I want to say thank you to AC and thank you to the hundreds upon hundreds of traders that have sent me these types of testimonials from all over the world. And it's really allowed me to see what types of information traders really wanted to see from a text and also from advanced training. And that really gave me the confidence to continue to pump out these types of educational opportunities for traders, because what makes this book so fantastic is that it really helps anyone from a scalper on up to an investor, because these concepts can apply to any market, any time frame, and it can help in any type of market personality. So right here you can see it says scalable to all time frames. And what this does, it allows you to use this information, use the techniques and concepts that I teach to profit in any market for all traders. If it's scalable to all time frames, that means that anyone can use it, from scalpers to investors, to active traders, to swing traders, and anyone in between. These concepts can be used from a 1 minute chart or a tick chart all the way up to weekly bar or monthly bar charts. And that's what makes these concepts so profound and useful. Additionally, these concepts can be universally applied to all instruments. That means it's perfect for traders that love to trade stocks, options, ETFs, futures, Forex, whatever instrument you trade. As long as there's viable price and volume information, you can use these techniques. And again, that's what makes a book like this so profound. The book Secrets of a Pivot Boss is also applicable to all market personalities, which allows you to tailor your approach to the market's current personality. That's something that's super important as well. These concepts allow you to trade a trending market, a range-bound market, allow you to forecast compression and expansion. So many different types of market personalities can be traded with the concepts that you'll encounter in this book. And again, that's another notch in the belt for this book that allows more traders to utilize its concepts for profits in the market. This book has a heavy emphasis on using market-generated leading indicators, and that is something that is super important as you continue through the text and read about these indicators. What's important about market-generated indicators is that these aren't lagging indicators. These are indicators that give you to the second updated information based on what the market is doing right now, not what the market did in history. This allows you to forecast future prices with much better accuracy and allows you to forecast what could happen in the upcoming period of time. And again, that's what sets apart traders that are professionals from novices. Another thing that makes this book so profound is that I gave away proprietary code and setups right there in the back of the book that allow traders just like you to incorporate these techniques and these systems so that you can create automated signals, automated programs, market scans, and those types of things. My background is in developing these type of algorithms, from using neural networks and genetic algorithms, that artificial intelligence that really helps you identify these opportunities and trade multiple markets. I've done that from a professional standpoint, and I've provided this code right there for you in the book. And that's something that can benefit all traders, especially as more trading goes to automated trading and algorithmic style trading programs. So this book, from so many different angles, can help so many different traders across so many different instruments in all time frames. And I believe that is one of the most important ways to approach the market, is that when you learn a set of concepts, learn a set of techniques and skills, you can apply them across any universe of stocks, across any universe of time frames, and this allows you to focus on the techniques and then just filter out those opportunities that come right to the top based on these money-making opportunities. So this is something that I really feel proud about. I really feel grateful for that I was able to provide this type of information for traders just like you. And what we're going to do in getting started with the secrets of a pivot boss is we're going to focus on how to get started with it right away. How can you incorporate the most foundational concepts so that you can begin absorbing that information and then using it for the more advanced techniques that come up later on in the book. So that's what we're going to focus on as we head on throughout the rest of this presentation. And if you look here, this is going to be our agenda for the current presentation. Secrets of a Pivot Boss lays that essential foundation for how traders must approach the market, which paves the way for more advanced forms of analysis and techniques that are also covered in the text. And what we're going to hit on here is just identify what are the different styles of analytical approaches that are covered in the text. And that's one thing about this book. Again, it provides a super foundation for how professionals approach the market and view the market and analyze the market. And in addition to that, it provides an array of analytical approaches that we'll cover here soon. But it's just immense, the amount of information that's in a 314-page book. We're also going to cover auction market theory. We're going to cover understanding value, the personality of markets theory, and the 4 market phases. So let's go ahead and get started with an array of analytical approaches. Secrets of a Pivot Boss introduces traders to a wealth of analytical approaches, from price-based analysis to volume-based analysis, from value-based analysis to pivot-based analysis, all of which can be applied by all traders, from scalpers to active investors, from stock traders to futures traders. And again, that was something that I did on purpose, because as I developed my trading approach over many years, both as an individual trader and also from a professional and institutional standpoint, one thing I wanted to do was develop my style of trading that allowed me to use these concepts universally in all time frames and in all instruments. I didn't want to learn a new technique for trading day trading and then learn a different technique to swing trade and then learn a different technique for end of day or investing. I didn't want to have to learn different techniques to manage my family's 401k versus managing an active trading account. I wanted to use the same foundational techniques, and that's what I did in this book. Additionally, if I was trading stocks versus futures versus options or Forex, I didn't want to have to learn a whole different set of styles or rules for those different instruments. I wanted to, again, apply those same concepts to all of those various instruments, and that was exactly what I was able to do with the concepts that are in this book. So the main concepts that we cover in the book are going to be auction market theory, price-based setups, market profile, volume profile, advanced floor pivots, advanced pivot range, and Camarilla pivots. All of these forms of analysis really help open up and give you a multitude of ways to analyze the market, from price-based analysis, value-based analysis, volume-based analysis, pivot-based analysis, pivot trend analysis, pivot width analysis, multiple time frame analysis, and confluence zones. These are all amazing approaches to the market, and in and of themselves, they can be complete trading approaches. So if you just wanted to use auction market theory, by all means, that's all you need in order to trade the market. If you just wanted to use volume profile, that's all you would need to trade the market. Likewise, for any one of these approaches, if you just studied one of these approaches, you can successfully engage any and all markets in any and all time frames. And that is what's super important. But when you begin to combine these approaches, That's where the power truly comes in, because then you can highlight confluent zones, you can highlight multiple time frame analysis, and really bring together just a force of nature for how to analyze these markets that is truly, truly powerful. We're going to go ahead and start here with auction market theory now. Auction market theory is used to understand how market participants act in an auction, including studying market efficiency, inefficiency, and optimal bidding strategies for each scenario. AMT is a self-contained approach that all serious traders must understand and implement. If you are a user of this auction market theory, again, you do not need to trade any other approach as long as you know this approach. But I would say this, while you can use any other style of trading, I believe all professionals must have a major foundational understanding of auction market theory in order to successfully trade any other market. So you have to know auction market theory inside and out. And these 5 key tenets of AMT will help you understand exactly what the market's about and exactly who is participating and where those key areas of value and undervalued and overvalued areas are. So the first key tenet of AMT is the market is an auction and operates solely to facilitate trade between buyers and sellers. So right there, that is something that is super important. The market only exists for one sole purpose, and that is to facilitate trade between buyers and sellers. And that is the case whether you go to the supermarket, whether you go to a clothing store, a car dealership, whether you're at the bar, whether you're trading futures. It doesn't matter. Auction market theory can apply anywhere. As a matter of fact, Craigslist is one of the biggest markets out there for secondary sales, of goods. And I use these same techniques when I am trading on Craigslist. You should see some of the amazing steals that I've gotten just from being able to use these concepts. So again, if there is a market, then auction market theory is the basis for how that market operates. And again, the sole purpose is to facilitate trade between buyers and sellers. Number 2, price is used as a tool to advertise value, and value is the dominant variable in the markets. It changes constantly. So if you think about this for a moment, price is only used to advertise value. So when you go to the store and you see the sales section, what are the vendors doing at that point? They are dropping the price in order to entice buyers to enter the market. That's exactly what's happening. And of course, when you see price start to rise, that tells you that demand is starting to increase as well. So this is something, again, that you must always know and understand, is that price is used as a tool to advertise value. So when price is going up, it's trying to do something. It's trying to motivate sellers. If price is going down, it's trying to motivate buyers to enter the market. And one thing that's really important is that in every single time frame, you're going to have different valuations. So if you're trading in a 5-minute periodicity, there's going to be value in that 5-minute chart. But if you're trading on daily bars and looking at months or years of data, then you're going to have a different value. So that's something that's very important, is being able to connect all the different value levels or prices in all different time frames. Number 3, price auctions higher to motivate sellers, supply, and lower to motivate buyers, demand. Again, price is going up to motivate sellers. And as soon as the last buyer has bought, then you get price moving lower in order to entice buyers to enter again. Anytime price is moving down, it's always because it is looking to entice buyers to enter that market. So that's something to always understand. As long as price continues to move up, it's motivating sellers to sell their supply. And then you see price dropping lower, it's because you're trying to see buyers enter the market. At which point will buyers enter the market and feel comfortable entering the market? That's when you're going to see buyers step in and start to push it the other way. Number 4, price auctions higher until the last buyer has bought, and auctions lower until the last seller has sold. So price will continue to walk higher until the last buyer has bought, which means When buyers feel that price is too high, guess what? They're not going to buy. And that's when price has to rotate or auction lower, again, in order to motivate buyers. And of course, if the price is auctioning lower, it's going to continue lower until it's too cheap for sellers to sell. At that point, you will see buyers step in and push it the other way in order to motivate sellers to sell their supply. Number 5, when buyers and sellers find an agreeable price, they trade in large volume, thereby establishing value. And this is the part that goes right back to number 1, which is the market is only around to facilitate trade between buyers and sellers. That's all the market is here for. So when the market does find a happy medium where buyers and sellers are happy to exchange hands, that's where you see value established. And value is basically where the most buyers and sellers are coming to the market to exchange trade. That's where you see the highest volume come in. That's where value is. Now, anytime price breaks free of that value, that tells you that price is now in a price discovery mode, seeking new value or prior value. So these are the 5 key tenets of auction market theory, which will help you on your way to understanding how to view the markets. If you print this out, put it right there on your wall or next to your machine, you'll always have these ready to go so that you can understand exactly why price is moving. Because if traders can understand why price is moving, then you can understand where you should deploy your capital at the most responsible price levels. Let's talk about participants now. Auction market theory basically has 4 types of participants in 2 distinct categories: initiative and responsive. And understanding the roles of each type of participant allows traders to diagnose who is in control of the current move and who is in jeopardy of having their stops run, which allows you to better position yourself in the market. This is very important because not only does auction market theory tell you about why the market is operating or why it's going higher and lower, why price is auctioning higher and lower, but it also tells you who the participants are in the market. And again, you have to know who your opposition is. You have to know who your allies are in terms of who's pushing price in one direction or the other. You have to know these participants. So initiative participants has basically 2 categories. You have an initiative buyer and an initiative seller. Initiative buyers buy above value, betting that price seeks higher value. These are aggressive buyers and they are seeking to influence price higher. Initiative sellers, they sell below value, betting that price seeks lower value. These are aggressive sellers seeking to push or influence price lower in order to establish lower value or retest lower value. So these are aggressive participants that are very, very strong in influencing price and pushing price from one value area into another. Responsive participants are the second group here, and there are 2 subcategories: responsive buyer and responsive seller. The responsive buyer buys below value, betting that price will return to value. Responsive seller, they sell above value, betting that price will return to value. So basically, these buyers and sellers, they respond to price being over or undervalued. These are sellers, for example, that will, when price pushes too high, they're looking to sell it so that they can return it to prior value. Buyers in a responsive category, they are enticed to come off the sidelines and will buy low in order to push it back toward prior value. So if you equate this back to going shopping again, if you go to the supermarket and you see that wine is on sale, this particular wine, they can't get it off the shelf for some reason, so they take it from, say, $15 a bottle down to $10 a bottle. Responsive buyer will come in and say, wow, that's fantastic. I'm going to buy $10 because that's below value and that's the best buy opportunity. Well, once bottles start flying off the shelves, what happens? The supermarket then raises the price back to $15, and that's exactly what happens here. You would see buyers come in at 10, buy 10, and when it gets back to 15, they go back on the sidelines, right? Same thing with an initiative seller or buyer. These are aggressive, remember. So if that $15 bottle of wine sits there, an initiative buyer may buy all of it. They might buy all of those $15 bottles of wine, so that when the supermarket says, wow, all of this bottle of wine is gone, the whole box of wine is gone, let's buy more and let's mark it up to $17.50 now. Basically clear out that inventory and push price to higher prices via demand. So you have to understand the different participants in an auction. You have to understand who is influencing price at which levels. And then you have to understand your role in the market, because we all are part of every single one of these types of participants at one time or another. Most of us are looking to be responsive participants. So when price, for example, gets too low, you want to buy it back to value. Or if price gets too high, you want to sell it back to value. But oftentimes when you're breaking out from a congestion, for example, that may be an accumulation range, then you want to become an initiative buyer so that price pushes higher during the markup phase, which we'll talk about soon as well. So again, understanding these roles is very important to successful trading. Let's talk about the auction market theory auction process. The auction process is ever present in the markets, in all instruments and all time frames. Understanding the market cycle allows traders to anticipate future price direction and behavior. This is very important. And this is a graphic that I built a while back because I hadn't seen a graphic like this before, but it's something that I believed was very, very important for kind of leaving a lasting impression in your mind when you see it. The auction process in the market is constantly in this ever continuous wheel of finding value and then finding that balance after value is established, and then seeing excess and imbalance, which is a price discovery phase. This is very, very important to how prices move. So basically, auction market theory provides the pathway for trading any auction, and price auctions higher and lower in search of value in order to facilitate trade between buyers and sellers. Remember, the market is only around to facilitate trade between buyers and sellers. And when buyers and sellers are happy trading at a certain price, that's where the most volume comes into the market. That's going to be called balance. So when the market finds value, establishes balance in that zone, it will trade in that area, maybe in the form of a trading range or a congestion, until excess is seen. When buyers and sellers establish value, price will trade within that balance until proven otherwise. And then once imbalance occurs, that's due to excess supply or demand. So if, for example, price is trading within a range and can't hold above the bottom of that range, that tells you right there that there is excess supply, and that leads to a sell-off. That sell-off is then an imbalance phase where price is seeking new value. So you're in a price discovery phase in a downtrending market, and price is seeking to establish new value or looking to retrade at prior value. And once that happens, it creates new balance. So once you have established that new value, you create balance, and now we're back into the top of the wheel again, where we're going from balance to excess to imbalance to value. So knowing all the cycles of the auction process allows its participants to give. So knowing the cycles of the auction process and its participants gives you the knowledge required to have longevity as a professional trader. Again, professional traders, professional floor traders even, understand the auction process. They understand exactly what the market is trying to do. The market is the same as it ever was. As you know, this is based off of fear and greed and uncertainty, right? These are all standard human emotions, and that's why technical analysis works, because it really feeds off the psyche of the human brain. And you know, when the human brain starts to panic and fear, what do? Sell, 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 market goes down. And then what happens? Well, now it's cheap, I gotta buy, and then the market goes up. When everybody's happy with price, it trades in a trading range until proven otherwise. So this process is a constantly evolving organism almost, where it just continues to evolve over time. And those traders that can understand where price is in relation to the auction process really have a leg up on not only understanding and diagnosing the current market, but also in forecasting future price direction and behavior, which is super, super important for traders. Let's talk about understanding value. Value is super important to trading as well. Participants identify value to discern when prices are undervalued, called a discount, or overvalued, called a premium, and will trade from either a responsive or initiative standpoint depending on their opinion of value. And that's why this can be very, very difficult at times, because every person has a different opinion of value. As a matter of fact, the market itself is a collection of opinions on value. Everyone has a different idea on the value of the market. And that's why you have so many buyers and sellers come in at all kinds of prices, because everyone believes something different. So again, if you understand that price is used as a tool to advertise value, then the biggest thing you should be identifying in the chart is value. Where is value in the chart? And with the book Secrets of a Pivot Boss, I teach many, many forms of value, from the value area that market profile outlines, to the volume point of control of volume profile, to the pivot range being the meat of the market. All of these various tools allow you to find value in all time frames. Remember, value is the dominant variable in the markets. It changes constantly. So as a trader, you have to identify value, and not only current value, but you have to identify historical value as well, because the market will trade back to historical value to retest key levels, especially if failures occur at current value. So this is very, very important. Price is valued differently in each time frame. As I mentioned earlier, whether you're trading in a 1-minute chart or a daily time frame, value is seen differently in all time frames, and that's important as well. So when I'm trading, oftentimes what I'm looking for is what is 1-day value, what is current 1-day value, what is 5-day value, and what is the higher time frame composite value. So I am constantly looking at 3 different value measurements and then trading between those value levels, because that's exactly what the market does. Participants in lower time frames, intermediate time frames, and higher time frames are all identifying value, and you may not even know it. One of the most important things to understand is that program trading is all designed around value. It's all designed to identify current value and keep historical value in a database, and then from there identify where price is likely headed based on these valuations. So when price is overvalued compared to current value, then programs are designed to sell it back to value. When price is undervalued compared to current valuations, programs are designed to buy it. They're designed to become responsive participants. There's other times where they're designed to be initiative participants. So you have to understand the value for the time frame you're trading, in addition to the time frame above and below in most cases. Historical value maintains significance into the future. This is something that is super important, because as the market continues to push forward into the future, oftentimes it will go back and retest prior historical value levels. And for example, if price goes bid at value and rallies for a month, well, once it exhausts itself and sells off, it's likely going to go back and retest that value level from the previous month. That's just what happens in the market time and time again. As a matter of fact, you can go out a year later and look at previous historical value levels, and you'll see that the market at some point in the future will likely come back and retest that value. So understanding value in each time frame is important, but also understanding that all value levels or previous value levels still maintain significance into the future. Demand drives value, and change in value reveals demand. So this is very important as well, because obviously if there is increased demand in a given instrument, you're likely going to see price drive up, and that will tell you that value is increasing. But as soon as value shifts lower, that tells you, the demand is now shrinking, and that is what causes price to sell off. So always keep in mind that demand is what drives value, and change in value reveals demand. The market moves from rejection, unfair pricing, into acceptance, fair pricing, and then back to rejection. This is the standard rotation of the market. So basically speaking, price will trade within balance around value. Remember, the market is around to facilitate trade between buyers and sellers, and when you find value, buyers and sellers will trade in heavy volume in that balance area. But when price gets too far away from value, it becomes overvalued. For example, if it goes too high, that's where price will then see rejection of those unfair prices, and responsive sellers will sell it back to value, which is acceptance and fair pricing. Not only that, you'll likely see price go through value toward the undervalued areas, and that will be back to rejection. So that's what I mean by from rejection to acceptance and back to rejection. It's likely price is rotating up and down around value, and that is just the standard rotation of the market. It's just how the market trades, and it's the way the market is always traded. One thing that I really found fascinating was, especially when you look at the book and in the appendix, I went back and looked at these concepts all the way back into the 1970s, and I was amazed at how these concepts continued to work. Prices were responding to the concepts from the book because I use market-generated indicators to help identify overvalued, undervalued areas and acceptance. So these concepts continue to work as they did decades ago, and they will continue to work in the future because they are based on market-generated events. Let's talk about the personality of markets theory for a moment. The personality of markets theory, PMT, suggests that price tends to experience various cycles of behavior or personalities over a period of time. Experienced traders tend to trade during the cycles that offer the best possible opportunities. And this is important because one thing that I really found when I was teaching traders over a decade ago was that traders wanted to trade regardless of what the chart looked like. And that is something that was very concerning because there are some charts that are just not meant to be traded, and there are others that just, it seems like it's too easy not to trade them. And there's a major difference between the two. And there's also various levels of gray area between. But something that's very important is that these markets shift between market personalities all the time. So number one, price experiences various personalities over periods of time. So this is why you might see a stock like Apple, for example, be in a super bullish uptrending move that just looks beautiful. Buy the pullbacks. And all of a sudden, it establishes a range at highs, gets really erratic and wild, and then you see a markdown phase where it sells off. It will shift between those various personalities over time. It's that cycle that we talked about. It's that auction process from value, balance, excess, and imbalance. It's just what happens. Price will gradually transition between phases or personalities over time. So that's why you will look at a chart sometimes, and if you scroll out and look at a year's worth of data, the first half of the year might be a beautiful trending market, and then the second half of the year is probably all erratic and crazy. It's just what happens again because, again, the market will shift through these personalities over time. And you just have to identify which personality the market is in at the current time, and it will likely continue to be within that current personality until proven otherwise. A volatile, unstructured personality offers more risk and inhibits the ability to forecast future price behavior, so you stay away from those charts. A well-behaved personality offers the best opportunities for trading and allows traders to better anticipate future price behavior, so those are the charts you want to trade. Oftentimes when I develop scans, automated scans for traders, the first thing I would do when I developed a scan was try to weed out the volatile stocks and bring only those nice, smooth moving stocks to the forefront. And, I would whittle down a list of 3,500 stocks down to about 50 of the best moving stocks. And then I would run signals on those 50 best stocks that were just exhibiting the best, smoothest charts. And over time, those 50 stocks would rotate out. It wouldn't always be the same. It might be 65 stocks, it might be 20, it might go up to 90, depending upon the market. And that's what's so important, is that you just have to continue to filter your list for only those best, well-behaved personalities that offer the best opportunities for trading. Now, keep in mind, price will remain within the current personality until proven otherwise. So if you have a beautiful trending stock that you're just allowed to just buy those dips over and over, it will likely continue to do that until proven otherwise. Likewise, if you have a stock that's just super radical and volatile, it's likely going to stay that way until it proves otherwise, so stay away from it. All right, let's take a look at a volatile issue. This is one that basically has no rhyme or reason to what it's doing. I mean, it's back and forth, up and down, all around, shoots way up, shoots way down. It's just, all it's doing is basically chopping up traders that are trying to get in. I mean, if you look right here and you have resistance and then price breaks through resistance, everyone gets in, and all of a sudden, boom, they run the stops all the way back down, so people get short, and then all of a sudden, boom, they run the stops back up. It's just a chop fest. This is the type of market that can really hurt your account, so you really have to stay away from it. But on the flip side, you have an issue like this chart, where you have a much smoother personality. You have much more structured trends one way or another, where this one's going up and down, and that's a perfect buy opportunity. It goes up, pulls back, another great buy opportunity. You're in a solid trending market. Then once you stop trending this way, you go into a super clean trading range market where you're able to trade the range. Once you fail to hold above the top of the range, boom, you see a markdown period, and now all of a sudden these are selling opportunities within the downtrending market. It just becomes super easy to trade an issue like this, where everything's much more calm and you can see exactly what's going on. So well-behaved personalities, again, offer those better opportunities for trading. They also help you with regards to what I call mental capital, that stress factor. Instead of being stressed out that, you know, this thing is chopping all around, it's a much easier, smooth sailing type of thing. Now, obviously, any stock can get hit at any time, whether it's an ETF or S&P 500 stock or Russell 2000 stock. It doesn't matter. But at the same time, if you're trading issues that have exhibited far greater smooth trading tendencies, you're likely going to remain in that pattern, again, until proven otherwise. And when you have issues like this that are trading much more uniformly in terms of which markets they're in, whether it's a trending market, a range-bound market, trending market in this way, it allows you to better anticipate future price behavior and direction. So this is something that I feel super strongly about. When you're looking at issues to trade, I always look to the left first. Before I buy this right here or sell it or whatever I'm doing, I look to the left first. How does it look in the recent 2 or 3 months? How does it look in the time frame before that? If it's been smooth this entire time, chances are it's likely going to remain smooth moving forward. Same thing if you have a volatile issue. If you go back to the recent example where we had this volatile issue here, if you're thinking about buying this right here, you know what? It's a toss-up. It could go up right now or it can go down right now because this thing is so choppy. This thing just turns on a dime. So if you're thinking about getting into this one and it's been a headache to the left, it's likely going to keep going and be a headache to the right. So that's something to keep in mind. Now, what the personality of markets theory does, it helps provide a pathway to the 4 market phases. So it goes from just doing the eyeball test of seeing if a market is volatile or well-behaved, and then from there, the 4 market phases allows us to further categorize which type of phase the market is currently experiencing so that we can anticipate what can happen next. So the 4 market phases were pioneered by Richard D. Wyckoff and help to provide understanding of the various price cycles that markets routinely experience, thereby allowing traders to better diagnose current price behavior and anticipate future price movement. And this is very important. And those 4 market phases are accumulation, markup, distribution, and markdown. And what's important about these 4 market phases is they allow traders to diagnose the current price behavior. So there's a great chance that one of these four phases is currently happening in the stock that you're looking at right now, whether it's a trending market up or down, or whether it's in a trading range market. Oftentimes there is no rhyme or reason, as we saw before, so you stay away from that issue. But when you are able to diagnose the market with one of these four phases, it helps you anticipate what the next phase may be, and that allows you to prepare for and anticipate that upcoming move. Traders that can recognize the market phases the earliest are able to identify the best profit-making opportunities. So if you are superior at recognizing these phases, then you will likely have superior entries and exits ahead of the crowd. You'll be able to identify that the market's about to see expansion because it's been in an accumulation mode, or it's likely to see a sell-off because it's in a distribution mode. These types of things are very important, and if you're able to see the patterns that the market is telling you, those signposts really help you prepare for the best profit-making opportunities, and they really allow you to take on less risk because of that, which is first and foremost always the most important, taking care and minding your risk. Number 4, allows traders to tailor their trading approach to the current market phase. So if the market is trending up, you should be looking to buy dips. If the market is trending down, you should be looking to sell rips. If the market is range bound, you should be looking to fade the edges. That's the most important thing, is that when the market is in a current state or phase, you have to be able to trade according to the state of that market. Too often traders try to use the same exact techniques for all market styles, and that's when you can really get hurt. Instead, you have to be able to identify which phase the market is in and then tailor the approach to that market phase. So here's a quick graphic that really shows you about the 4 market phases. Number 1, this is the accumulation phase right here. And the accumulation phase is basically an area of balance where the market is happily trading within that balance zone. Remember, the market is around to facilitate trade between buyers and sellers, and when buyers and sellers find agreeable price, it trades in high volume. But what's happening in this accumulation phase is bulls are down here, and these are usually institutions that are developing and building their positions. Eventually, they build a solid enough position where you usually see expansion to the upside, and that sparks the markup phase. What's important about an accumulation phase is that institutions are here buying at every rotation, but at the same time, they're attempting to keep price within the range, because institutions can't come in here and buy, $100 million of a stock without in one go and just push buy, because that will likely influence price too much, and you're going to get erratic fills and you're going to see price drive up. So during the accumulation phase, what you usually see is just gradual buying of building of that position until finally you see that expansion. And once you see that expansion, the markup phase is the uptrend phase that you see. That uptrend phase is where retail buyers come in and push the market even higher. Additionally, you may see price markup and then form a smaller reaccumulation phase within the markup period, and that again, it's like a consolidation that just further pushes price in the direction of the existing trend. Eventually, what happens is institutions begin to liquidate their positions. So if they got in down here, they're selling some along the way. And then up here, this is when they really start to sell. And not only sell, but they start taking the opposite direction. Meanwhile, you have buyers, retail buyers in here defending these lows, and they have sell stops all down here. Who's going to win, retail buyers or institutions? Institutions have the bigger wallets. They're usually going to force the downside sell stops. And what happens in this phase is you usually see the sell stops trigger that mark down, which is a downtrending sell-off. And that's when margin calls occur as well. And that's when you really see the market drop significantly during that markdown phase. Eventually, you'll see another form of accumulation, and again, that'll lead to a mark up, and again, the pattern continues whichever way it goes. So this is just a quick graphic that really shows you how the market operates, generally speaking. So the 4 market phases, let's concentrate on accumulation right now. The accumulation phase occurs when institutional investors begin buying substantial supply of stock over a given period of time, which creates compression that eventually fuels a markup phase. Institutions gradually buy large amounts of stock over long periods of time so as not to drive up the price. Again, the average retail buyer may buy 100 shares of something, a couple few thousand, maybe even 20 or 30, $40,000 of a given position. But institutions are trying to deploy much larger sums of money, millions, if not tens or hundreds of millions of dollars. And it's very difficult to do that in one buy order because it's going to influence price way too much. So instead, what they'll do is they'll buy, a couple million here on the first day, maybe a few more million on the second day, maybe a few more million on the third day. When price comes up, they sell some of those and keep a cap on the market. And when price comes back down, they add to their position. When price comes back up, they sell a little bit more to cap the market. When price comes down, they're buying a little bit more, buying a little bit more. Meanwhile, they're capping it off. Eventually, market pushes through the top of that accumulation phase and it sparks the markup phase. And this is when most of the retail buyers come in. They say, whoa, price just broke through the top. Let's get in, buy, buy, buy. And then the retail investors push push prices much higher, all the while making the institutional buyers much, much more money because they got in much lower. So the institutions are gradually buying over a period of time, and they're trying to keep price in that range so as not to drive up or disturb the price. So what happens is a trading range forms, and this is a trading range or base, and once that forms, that compression will fuel the markup phase, because you also have sellers that have come in on the top and they have buy stops above that range. And when those buy stops are triggered, it triggers a cascading effect to the upside and sparks that markup phase. Again, being able to recognize the accumulation phase gives insight into future opportunity. So if you see price accumulating at lows, and then you have a pretty good idea that you're likely going to see an expansion phase ahead, whether it's to the upside or the downside. But the important thing to note is that the larger the period of accumulation, the more pronounced the expansion phase is likely to be. So if you have a super, super pronounced accumulation phase, you're likely going to see a major, major move out of it. This is a period of months here where you saw price accumulating, and then one day you see price shoot through the buy stops, you see a retest of the top of the range here, and then you just see price shoot off to the upside. And that is very, very typical of what can be seen out of an accumulation phase. All right, let's talk about the markup phase now. The markup phase is a bullish expansion phase that occurs after and is fueled by the accumulation phase. While institutional money enters during the accumulation phase, retail participants enter the market during markup. So again, if this is an accumulation phase here and you eventually break to the upside, again, this is when the general retail market is here saying, oh, I want to get in because I don't want to get left behind, and price continues to push up. Meanwhile, when you get pullbacks, institutions are coming in, savvy traders are coming in, buying those dips and fueling the next short squeeze. So this is very, very important to understand. Price experiences expansion from the accumulation phase, which triggers a bullish trending move when the buy stops are triggered. Remember, you also have sellers that are coming in, establishing sell positions off that resistance. Where do they put their buy stops? They put their buy stops above the top of the range. Boom, you see a big time move push through those stops. And simultaneously what happens is when price comes back, now you have a bunch of limit buy orders sitting right at that prior resistance, ready to turn it into support. Again, that's institutional help. Creating a floor right at that level, which again leads to another squeeze to the upside. And again, the process continues. The accumulation phase fuels that markup phase. And again, the greater the size of that accumulation phase, the greater the eventual markup is likely to be. Institutions develop positions during the accumulation phase, and the expansion phase is when the retail money enters the market. So when I say it offers the best trending buy opportunities, whenever you see a significant accumulation phase and then you see that first breakout, oftentimes the first pullback is going to be the best buy opportunity right there, and you can see how significant that move was. And then you see the next pullback again. That is another trending buy opportunity. You buy the dips and boom, you see another short squeeze. Then it pulls back again and then boom, you buy it again. That's why I say it offers the best trending buy opportunities, because once you know that you've gotten free from that accumulation phase, you know that the expectation is now for a trending move in that direction. All you have to do is be patient and wait for the undervalued pullback buy opportunities in order to engage the market. All right, let's take a look at an example of an accumulation to markup phase. This is a daily time frame here where price basically saw accumulation for a period of about 3 months right here. And if you think this is a coincidence that price formed a perfect little rectangle down here with perfect buy and sell opportunities at the extremes, it's not. It's not a coincidence at all. This is the way the market is designed, for bulls to come in and defend the bottom of the range with huge orders, meanwhile selling the top of the range in order to take some of those profits and then reinvest the profits when it comes back down. So for example, bulls may come in and say, I'm going to buy 5,000 shares here. An institution's going to buy 5,000 shares right there. When it comes up, they may sell half that position and make the money. When it comes back down, they may put that second half up and reinvest that money. And then when it comes back to the top of the range, they sell again and make more of that money. Meanwhile, they have the original half still on. When price rotates back down, they may add another half to that position and rotate it higher until they take some more profits or break free through the range. So what they're doing is they're accumulating that position in many different ways. Again, you could start with 5,000 here, sell 2,500. When price comes back down, they might buy another 5,000, and when price comes back up, sell 2,500. When price comes down, they might buy another 5,000, and they're just accumulating that position over time. But the important part is, during this accumulation phase, it's a orderly range that allows bulls and bears to establish balance, and from there, once you see excess, you're likely going to see a significant markup phase. And here it is. You see the break through the top, and it never looked back. Once price really got going, the first major sell-off right here, boom, was bought, and you see this thing shoot higher. Then the next major pullback, boom, was bought, and you see this thing shoot higher until the pattern stops. So this is just a clear example of a significant accumulation phase where buyers came in, institutional buyers came in, developed a significant position, and once price breaks from that range, you usually see a significant markup phase. The other thing here is that once you know that this accumulation could lead to a markup phase, you're ready to trade that breakout if it occurs, or you're ready to buy those pullbacks if they occur. Take a look at this setup right here. This is my favorite setup of all time. This is what I call the extreme reversal setup. It's this large extreme sell-off followed by this green bar here, and it leads to a significant reversal in the opposite direction. That's what I call the extreme reversal, or the X bar setup. And this is basically covered fully in my book Secrets of a Pivot Boss, in addition to the code for that setup. And it was my first major home run algorithmic strategy that I ever created over 10 years ago. And basically this strategy allows buyers to enter the market as if they were institutions. It's the exact same thing that institutions run their strategies off of. When price sells off too much in an uptrending market, bulls come in, defend after that huge sell-off. They basically become responsive buyers, and they buy below value here. And then you see a major move in the opposite direction. It's what happens time and time again. You see it again right here, where price comes in and boom. You see it again right there. Price comes in and boom. It just happens over and over again. So this is something that I teach in the book Secrets of a Pivot Boss, and I'll also be teaching in the Secrets of a Pivot Boss Bootcamp. But it's one of my favorites. So if you see this huge accumulation phase, you see this thing break out to the upside, as soon as you see this pop in, that's your surefire buy opportunity for a likely squeeze to new highs. All right, let's talk about distribution. The distribution phase occurs when institutional investors begin slowly liquidating, selling, their inventory of a given stock over a period of time, which creates compression and eventually fuels a markdown phase. Institutions gradually liquidate large amounts of stock over large periods of time so as not to disturb price. This is basically the inverse of the accumulation phase. So right in this area right here, price had probably trended higher, and once it trended higher, remember, the bulls who got in long off of that accumulation phase are now starting to liquidate their position. They're starting to take major profits, and every time price comes back to the high, they're selling it. When price rotates lower and comes back to the highs, they're selling it, and then they start creating a position to basically sell the market in the opposite direction. Meanwhile, if prices are making new highs up here and holding near highs, the average retail investor comes in and says, wow, this thing has been at new highs or trading around highs. It must be super strong, so I'm going to come in here and buy it. Meanwhile, they're putting stops below the bottom of the trading range. What happens is institutions force those stops to be triggered. You see the sell stops get triggered. You see the margin calls come in, and then you see a swift sell-off and a markdown phase. So the distribution basically fuels the markdown phase, and of course, it is when those institutions are gradually liquidating large amounts of stock, in addition to building a position in the opposite direction. So a large trading range develops at highs as they're liquidating that position, but again, you don't want to sell all of your inventory at once, because again, that could lead to a sell-off event like this. Instead, you want to sell a little bit at a time. So when price comes up, sell a little bit. When price breaks down, you may buy some and then sell it a little bit more. Rotates back down, buy some and sell a little bit more. So what they're doing is they're selling gradually over time so as not to disturb price. Now, of course, the compression that is created by this distribution range will fuel a likely expansion phase, and it's usually to the downside, obviously, if it's a true distribution range. Now, one thing that can be difficult is deciphering whether a range is a distribution range or an accumulation range, because oftentimes it's very difficult to understand which is which, but there are some signs, especially if you're looking at the market and the market has a significant pronounced uptrend, and then boom, sells off quickly to establish the bottom of the range, and then goes back to retest the top and can't get up and comes back. That's likely going to be a distribution range. And that's what happens here, where price goes up and then can't get up, and boom, immediately comes down, finds the bottom of the range and shoots right back up, and now your range is formed. Of course, a pattern of lower highs helps to identify whether you're likely going to break to the downside, in addition to failed higher highs as well. Now, recognizing a distribution phase gives you insight into future opportunity and provides likely the best sell opportunities once that markdown phase does occur. So let's talk about the markdown phase. The markdown phase is a bearish expansion phase that occurs after and is fueled by the distribution phase. While institutions liquidate during the distribution phase, retail participants generally exit the market during markdown. So what happens here is that institutions have been building a sell position. Look at the pattern here of lower highs, and eventually what happens is those sell stops are triggered down here, and you have a huge downside cascading effect. This is when retail investors or retail traders start to get their stops triggered or start to enter the downtrending market as a new position. So what you do is you see sell stops that get triggered, and then you see new existing shorts come into the market, and you just have a major downtrending event. And I always say, it's an old adage, that the market takes the stairs on the way up and then takes the elevator on the way down. So anytime you get into a markdown phase, the first failure to hold above the top of the distribution range likely sparks a significant selling event. That panic selling, that fear enters the market, and you usually see a significant swift move to the downside. So oftentimes, if you're able to recognize a distribution range early, you can likely forecast that you're going to see some type of significant selling event ahead. So the distribution phase fuels the eventual markdown phase, and of course institutions develop that position during the distribution phase, and the expansion is when the retail money exits the market. The markdown phase offers the best trending sell opportunities. So once you get established in that downtrending market, the first bounce is usually seen as a selling opportunity for new lows. So anytime the market rips during the downtrend, you're likely going to see sellers come in, defend that bounce, and push price back to new lows. All right, let's take a look at an example. Here is a distribution to markdown phase, but it's fueled initially by the markup phase. So price marks higher, and then once it gets to these highs, you can see here it starts to build a range on highs. Once price fails to hold above the bottom of the key range there, you see a major sell-off event, and then you see the markdown ensue. So this is very important, and actually this is one of my favorite distribution ranges because it's easy to identify. You have a kind of an upward slope to it here, and really what that upward slope shows you, every time price makes a new high, the market fails to see acceptance at those price levels, and price rotates and auctions lower. And then price comes up and tries to make a new high, and there's a failure to see acceptance, and it marks lower. And then price comes up, makes a new high, fails to see acceptance, and it marks lower. Right there, it's showing you that the market, while healthy and while setting new highs, really isn't seeing acceptance at those levels, and instead institutions are selling at every moment. So what happens is usually when the market's making new highs, the average retail trader is just seeing headlines at the end of the day, market at new highs, market at new highs, and they're thinking, wow, this thing is super strong, I don't want to get left behind. So what they'll do is continue to buy up here. Meanwhile, institutions are basically selling their inventory to those retail buyers, and eventually what's going to happen? Those buyers have their sell stops below the bottom of the range, and when that bottom of the range is triggered, you see sell stops, you see margin calls, you see panic selling, and then the market starts to rip lower. And once the market sells off, that first bounce is seen as a selling opportunity to new lows. The next bounce is seen as a selling opportunity to new lows. The next bounce is seen as a selling opportunity to new lows. And the pattern continues and continues until proven otherwise. So this is just a standard chart here where you can just see the laws of the 4 market phases in full effect. Again, it's the personality of market theories that really helps you identify which stock charts or which charts in general should I trade. Do you trade the volatile charts, or do you trade something that is demonstrating proper market structure and price movement? Every time I say, before I pull the trigger, I look to the left of the chart and I see what has been the most recent price behavior. If I can understand the rhyme or reason to that chart, then I'm likely going to be able to better forecast what's going to happen in the upcoming period of time. And that provides a much better opportunity with less risk and higher profit potential. So Secrets of a Pivot Boss lays the essential foundation for how traders must approach the market, which paves the way for an array of analytical approaches. And again, I'll say it over and over again, my book, Secrets of a Pivot Boss, has been loved worldwide because I've been able to not only provide foundational pro-style concepts that all traders must know, but then I basically parlay that knowledge into much more advanced concepts that allow for an array of analytical approaches. So Secrets of a Pivot Boss lays that essential foundation for all traders, which is super important because any trader in any market can use this information, whether you're trading 1-minute bars or trading monthly bar charts. In addition, Secrets of a Pivot Boss teaches an array of analytical approaches, from price-based to value-based analysis, which can all be used, again, by all traders, from scalpers to investors. Auction market theory, remember, it provides that pathway for trading any auction in any time frame. If you see a pattern here, it's because I did it on purpose. Every single one of these techniques can be used by anyone trading anything, and that was on purpose. Understanding value, You have to be able to understand value if you're a trader, because it allows you to discern when price is at a premium or at a discount. And this allows you to analyze the market in all time frames and allows you to deploy your capital at the most responsible prices. And again, the personality of markets theory and the 4 market phases, these allow you to diagnose current price behavior so that you can forecast future price movement and forecast where price is likely headed with less risk and more profit potential ahead of the crowd. And every time you can employ these techniques in your trading, you have a leg up on your competition, and you have a much better handle on where price is likely heading into the future. So with sincere gratitude, I'd like to say thank you for being a part of the Secrets of a Pivot Boss Bootcamp. It is my sincere expectation that this Getting Started with Secrets of a Pivot Boss training will allow you to absorb the concepts from the book in a much quicker and more profound manner so that we can tackle the much more advanced concepts ahead that will help you become a much more confident and successful trader. For everyone at Pivot Boss, I am Frank Ochoa, aka Pivot Boss, wishing you amazing success in your trading.